Welcome, you're watching Talking Stocks. I'm Demisha Greater, and in studio with me today is Sean Ashton and David Lindeque from Anchor Capital. We're talking EOH, an outsourcing and information technology company which provides consulting, technology and outsourcing services. Gentlemen, welcome. Sean, let's start with you. Why in particular we're looking at EOH today?
So I think this is a company that's been delivering the goods for a very long time, both through a combination of very, very strong organic growth within the markets that they serve, as well as a strategy to make bolt-on acquisitions that have actually served to create quite a lot of critical mass over the years and augment the growth rate of the company quite significantly. So it's a business that's been delivering north of 20% growth year in, year out for quite some time. And I think it got to a point where the rating got a bit ahead of itself. People were becoming almost too bullish about the growth outlook to the extent that the P multiple became very high. And it's been derating to an extent in recent months to the point now where we think the valuation offers somewhat more compelling value.
Mm-hmm. And David?
I agree with Sean. If we look pre-results for the first half of 2016, its trailing PE was as high as 32 times. So it's derated significantly. Based on our forecast, we view it as a forward 16 times with the ability to grow HEPS by 26.3%. We believe that with this derating, there's not many growth stories on the market at the moment at these multiples. And they've proven over time that they can achieve this growth rate. If you look, 42% CAGR revenue growth over the past 4 years, 43% EBITDA growth rate over the past, CAGR growth rate over the past 4 years. We really like this company and its growth profile.
Sean, their results came out, 9th of March
Sure.
or so. Markets weren't particularly impressed. We saw that stock price down more than 3% on the day. Was this justified? And
I think part of the issue with that particular result was a bit of a miss on cash conversion, which we think will come back into the coming reporting periods. So their cash conversion relative to earnings was somewhat down, so debtors days moved out. This is a business that generates substantially more cash flow than some other IT companies. If you think about a Pinnacle as an example, much lower margins, but more of a box dropper. They earn a lot more in the form of inventory. So it's a very different business model to what EOH does. It's fundamentally a better cash generator. But in that particular reporting period, cash flows were under a bit of strain, and we expect that to improve in time to come. And that I think would be the part of the reason for the sell-off. And I think the other part of it is valuation starting point. When you're at a trailing north of a 30 times P multiple, there's a lot of expectations built into a share price. And I think it's needed to have consolidated for the time that it has. And we'd be of the opinion now that at kind of a mid-teen forward multiple, that's somewhat more reasonable. And if you think about the growth model of this company, and you break out the first, that reporting period, 25% odd growth. We estimate, and they don't disclose this exactly, but given the kind of metrics that they tend to acquire businesses at, we reckon about an 8 times PE multiple that they would tend to pay, split roughly over time 50-50 between cash and issuance of shares. So they're a big issuer of shares over time. If you back that out of the equation, we reckon the underlying organic growth rate's about 15%. So they've had the ability to add another 10% on top of that annually in terms of earnings growth. They might slow somewhat, but we still think this is a business that can grow north of 20%.
David, let's look at it from a segment perspective. If you look at the services sector, which is the biggest contributor when it comes to their total profit before tax, maybe just give us an indication of where we're likely to see growth coming from.
So obviously, as mentioned, services contributed 68% to total profit before tax. That still continued to grow at a really great rate. However, outside of services, what we're really interested in is their software division. Software, they grew profit before tax in the first half of this year at 164%. And that's really through the offering of niche specialized services to large corporations and governments. If we continue to have that view, we believe that the company's ability to offer these really specialized niche ICT services, of which they own the intellectual property, we think that there'll be great growth coming from these services moving forward.
Sean, something interesting that I picked up with EOH, obviously they are looking at expansion. You said organic growth, but they're also looking to list in Turkey, that emerging market exposure. Just give us an understanding of the Turkish environment at the moment.
So I'm not an expert on Turkish ICT by any stretch of the imagination, but yes. I think that certainly management's view is that Turkey has some similarities with South Africa, but is probably a number of years behind it in terms of the evolution and the development of their market. So I think it's opportunistic from their side. I don't think that it's necessarily a sign to say, listen, we've tapped out our growth opportunities in South Africa, but I would expect that there are fairly chunky deals that they can do in Turkey in time to come, for which they may want to raise capital on that market. I think it's probably worthwhile touching a little bit on the risks associated with EOH, because it's obviously been a great success story over time. I think when you're moving into brand new markets, there is the risk that you don't know that market quite as much as you do in South Africa. And I think from a scale point of view, as you're becoming bigger and bigger, the types of deals and the number of deals that you need to do to sustain the growth rate obviously grows quite a lot. So you're potentially taking on more risk with incremental transactions. And then again, also, I guess there's an element of key man risk, in the sense that if you've acquired businesses and you've brought those entrepreneurs into your company and incentivize them with shares, once their lockups are done, there's always the risk that they kind of take their money and run and sail off into the sunset. But I think they certainly would maintain that their culture addresses this to an extent, that EOH is a place that people want to work rather than the other way around. And certainly the track record bears that out, but that certainly is a risk to bear in mind.
David, any particular risks that, from an investor's perspective, one should be cognizant of?
Well, obviously, this company generally operates in emerging market territories. And as much as they say that the company is really resilient and defensive in weak macroeconomic growth environment, there surely will come a point where that demand might face headwinds due to the slowing macroeconomic demand. And I fully agree with Sean about the key man risk. At some point that will occur. And I also believe that they buy in these companies sometimes in a really young phase, and they really can't be certain that they'll continue to perform in the manner that they have been. So there's that element of risk. But overall, I think it's a great growth profile. As mentioned, they do offer really niche services that are really defensive. And I think that's what's important, is that they're not offering services that are additional add-ons that might be almost a luxury to a company. If you look at what they're actually offering, they're offering services that, despite a company's actual financial performance, they're going to need these services. And that does give them that defensive ability. And if you break it down and you look at their client base, they obviously serve large corporations. But if we look at it, their largest client is 3%. We were particularly concerned with the exposure to the banking industry. South African banks actually only contribute 6% of top line. So they are quite hedged across various industries that they serve. And we believe that this growth will definitely continue moving forward.
Sean, I want to pick up on a couple of points there. First of all, I've been hearing the word niche quite a bit. So in terms of competitors in this particular market, you mentioned Pinnacle just a moment ago. Who else is EOH going to be? So
Pinnacle is very much a distributor of components and parts, etc. And kind of the IT hardware, if you will. I think their strategy has been they've obviously acquired a shareholding in Datacentrics, and Datacentrics is a lot more geared towards the services aspect of information technology. So that would be the part that really competes with EOH. EOH is a big business now. I mean, this is a company making north of R1 billion worth of bottom line profit at 20.
So no real competitors.
Well, I wouldn't say no competitors, but it's obviously a large ICT player in this market. But I think it's what management would define as their addressable market is probably a lot broader than what we would traditionally think of. So you could include companies like human capital, for example. I mean, anything relating to the employment of IP and specifically human intellectual capital. That's kind of an addressable market for these guys. It's not. I don't think we should just think in terms of IT businesses. It can be consulting across a broad spectrum of applications. So I would expect that this company will increasingly diversify their addressable market and product offerings, and that means that it's a very large market. Almost quite hard to define how big it is.
Yeah. David, I want to go back to, you're talking about the different clients that they've got in terms of their large caps being diversified, having emerging market exposure. I think the big headlines lately have been around Brexit and to what extent maybe African markets or emerging markets have been impacted. Corporates maybe not coming under pressure. Is that something that you maybe foresee government expenditure. To what extent is this particular company still able to capitalize on this, seeing that we are still very much globally in a low growth environment?
Well, obviously, I think post-Brexit, there's a lot of uncertainty in global markets moving forward, and macro scale on a global level. However, this company, as mentioned, the services they actually offer, if we break it down, some of the services they offer, they do cost saving, energy efficiencies, data analytics. So they're not really purchasing hardware or purchasing services and products that they don't need. I believe that of the ICT companies listed in South Africa, this is probably the most defensive and resilient against weak economic growth. And this is something we actually really pushed management in meetings. And we actually pushed them and asked to what degree do they think that demand will wane in a low growth environment. And they actually believe that that's not the case. They believe that at times when companies and their clients are performing poorly, it's almost a time where they actually need to contact EOH and actually get some of these services on board. And we actually had the Investor Day recently and we looked at their services, and just to touch on what Sean was saying, this company offers a wide spectrum of services, from assisting the South African Police Service with various crime-solving analytics, to finding out revenue per square meter for a retailer putting in a new store. They offer a really broad, diversified portfolio that I believe in a weak growth environment is not one particular segment is going to get hit too hard. And in this environment that we currently find ourselves in, there's not many companies that are offering this growth and this defensive growth.
So strength through their diversity there. It's time now for us to find out if our experts are going to buy, hold or sell on this stock. Sean, where are we, buy, hold or sell?
So for me it's a buy. I think market conditions in the near term look a little bit wobbly, so it's not to say that you must expect immediate returns. I think things can remain volatile, and given the market cap positioning of the stock in the market, it can be very volatile. And that should be borne in mind. But if over any meaningful time period, kind of a year plus, this would be one that I'd be looking to accumulate around these levels.
Where are we sitting with you, David?
I agree. I would definitely buy. Obviously, the share is derated, and now at a forward 16%. 16 times forward multiple. We actually really like it at these levels. There's not many companies that offer this growth profile and this defensive element that EOH does.
Right. Gentlemen, thank you so much for joining us. Unfortunately, that's all we have time for today on Talking Stocks. So both of you, when it comes to EOH, defensive when it comes to the diversification strategy, a niche market there, and of course we will be waiting to see how this particular story unfolds. A very big thank you to Sean Ashton and David Lindeque from Anchor Capital. That's it for today. Of course, join us again next time when we talk more stocks.